Earlier, our Cris Valerio gave us details on Zynga filing an IPO, and now she's back with a guest to continue the discussion on what's ahead for the social gaming company. Cris?
Hey, Mark, that's right. We're joined by Bob Rice of Tangent. Bob, thank you so much for coming.
Thanks,
I have
Cris.
to ask the first question here. Just if you can give us a little bit of your initial reaction from going through that S1, so much anticipation. What do you think?
Well, I think that this is one of the few prospectuses in which people would really genuinely be well advised to read the risk factors. Normally, you know, those things are kind of boilerplate and you look at them and you move on. But in this particular case, they have a lot to tell you and people need to pay attention.
Well, let's go through some of those, because I know the big one, of course, is Facebook, right? You called them, I think, conjoined twins. So much of its revenue comes from that. Do you think that they stressed it enough in the S1? What do you think investors are going to be looking at with regards to that relationship?
Well, I think so. There are several things to pay attention to there. One is that Facebook, of course, has forced them to use only the Facebook credits for their future revenues on the service. But, you know, the thing, it's not so much Facebook itself that concerns me. It's the few number of users of Zynga that contribute to so much of their revenue. They say that nearly all of their revenue is attributable to just a handful of users. And that's kind of an alarming statistic. You know, you look at the raw number of users, and you think, hey, gee, this is a very stable pyramid of users from which I'm going to be drawing my revenues. But it turns out it's only the top couple of percent who are actually generating a lot of money, but it's only a very few number of users.
Well, and one of the things I think it also mentioned there was the idea that it was a small number of games that they're actually monetizing, right?
Very small number of games. And, of course, this is a big problem because Farmville, for example, has started to drop off in popularity. And it's a real question about whether or not the company is going to be able to continue to crank out these games that people are going to use and buy these virtual goods inside of. In fact, the combination of the single distribution channel, the few number of users, and the few number of games makes this about the most concentrated source of revenue I can ever remember a company going public on.
Bob, can I ask you about another risk factor? Because one of the things they mentioned was the need to beef up its infrastructure. This was something that I haven't really seen in a lot of the filings that I've been looking at. And it specifically refers, all of its servers are hosted in the cloud. Do you think this is something we're going to see as we see more companies come to go public, this as a risk factor, especially given that it monetizes based entirely on that cloud?
Well, it's kind of an odd risk factor to me. I mean, I think it's one of those things the lawyers make them put it in, but it's hard to see that as really a major risk factor because, of course, you can get duplicate capacity in the cloud, and it's nice from the company's point of view because they don't have to maintain all those servers.
Bob, another question here is we were looking at the multiples, right? It made $235 million in this quarter. If you annualize that, let's say $1 billion for the year of 2011, the multiple on that seems to be a lot more reasonable, perhaps not as bubbly as we're seeing for other companies like LinkedIn, for instance, that went public. What do you think about that?
Well, if you use LinkedIn as the benchmark, then you're right. It's more reasonable. but I'm not 100% sure that that's where I would go. You know, the problem when you're in a bubble is that you tend to look at the other companies that are in the bubble and say, well, gee, this looks okay because by comparison to that, it's fine. But if you look at traditional metrics, you know, it looks a little risky to me and a little pricey. You know, companies, is this company really worth more than Yahoo at this point? I'm not so sure about that.
Well, you brought Yahoo up. I just have to ask a side question here. Last week we talked about Yahoo perhaps wanting to purchase Hulu. Today we find out Google might also be there. It's shopping itself around. Everyone I've been talking to says Hulu as a company and as a monetization strategy is questionable. Jason Kilar as a CEO is what people are wanting. How do you see this whole situation with Hulu playing out?
Right, I agree with that. Hulu isn't making any money, but of course it is drawing major traffic, and it looks like it's going to be positioned to actually compete against a lot of the cable operators going forward at these kind of growth rates. For a company like Google, it really could make a lot of sense because obviously there's a tremendous amount of viewers that you can monetize through advertising. And that would make sense for the company to be sold to a strategic investor who's got some other way of monetizing that traffic.
Bob, when we look at like IPO and acquisitions, is there to a certain extent these IPOs, because they're becoming so highly valued, is that play badly for acquisition strategy, for instance, with a company like Hulu or other acquisitions out there? How do you see that measure playing out?
Right. I think that, well, it's a question of whether or not the target is going to be willing to accept stock in a private company or not. I mean, this is the one advantage that Zynga really gets, aside from, of course, massive cash out of its original holders, which is great for them, but not so great for the investors. The one thing that's really good for the investors is that now Zynga has a currency with which it can go around and buy up all competing young gaming companies that are in the social gaming space. And so that's kind of the metric that you see in the old bubble and in this bubble. In both cases, you're looking at investors essentially giving management teams currency to go buy up the rest of the players in the industry. And if they do that intelligently, then these things can work out. So there will be some winners in this space because of that dynamic.
Bob Rice of Tangent Capital Partners. Bob, thank you. I appreciate the insight. Mark, back to you.